Welcome to Kitco News. I'm Niels Christensen. The gold market has been fairly choppy the last few months. Investors appear to be waiting for a new catalyst to push gold prices into a new trading range. Here to talk about his outlook for the precious metals market is Jeff Clark, Senior Precious Metals Analyst at goldsilver.com. Jeff, thank you very much for being back on the show. It's a pleasure to talk with you again.
Yes, Neil, it's great to talk to you again.
So let's just jump right into this conversation. Gold is stuck in a $100 trading range. We're seeing better than expected economic data come out. What are your thoughts? Does the gold price suffer as economic data starts to improve?
So the economy may be recovering somewhat. Certain aspects of the economy are recovering. Others are struggling. Some may never get back. So it is going to be a new normal, as you might say. But gold isn't just about the economy. There's many other catalysts that can propel gold higher. We saw the reaction of gold to what the Fed has done, the unprecedented actions they've taken, and that's probably has a bigger impact, quite frankly, on the gold market than what the economy may or may not do and what certain aspects of the economy may or may not do. The biggest things, of course, being printing of currency, taking rates down to basically zero, buying almost everything in sight, even junk bonds. Whoever thought we would see, the reserve currency of the world, the government behind that, actually buying junk bonds. So all these things are really unprecedented. Those are the drivers behind gold. The real big thing, though, for me is when we see some real world effects of all this money printing and all this intervention by the Fed and all the manipulation, when we see some real world effects of that, that's when I think gold starts its next leg up. So I do think gold is in a major bull market. It's just taking a pause like it does many times in almost all bull markets.
What do you mean by real world consequences? Do you want to see inflation spike higher as we react to this massive amount of central bank stimulus?
The great thing about gold is you don't need to be right about what the crisis might be. I do think we're going to get inflation at some point. I think it's frankly inevitable, but that could be, not till this fall. It could be 2 years away. But you don't have to be right about what gold is going to do, because the number of ramifications and the fallout from all these unprecedented actions are going to squeak out in many different directions, if you will. And all those things cause uncertainty. Those things cause volatility. They affect markets. They affect economies. We don't know exactly what that catalyst is going to be. There's probably going to be more than one, but you don't have to be right about the catalyst to own gold. I think it's going to go higher when these things start to happen. And yes, inflation will be one of them at some point.
What are your thoughts on the equity market as we've seen markets rally sort of post-COVID-19 pandemic? Equity prices are up 40% off the March lows. Everybody's sort of talking about a sharper recovery in the global economy. Is the need for a safe haven reduced in this environment?
Some of that rebound that you're specifically referring to is just that. It's a rebound. It's still not back to normal. Employment is not back to normal. Retail numbers are not back to normal. They're not back to any of the pre-recession levels. The recession's not over. So that's all good news. We can celebrate that. That's great for our economy where we all live and use commerce and that kind of thing. That's all good. But this is unfortunately not over. There's other fallout to come, especially from the unprecedented actions the Fed has taken. So I think everyone needs gold in their portfolio going forward. You probably need physical gold, though, for lifestyle protection. So you need gold for portfolio protection. You need physical gold for lifestyle protection. There may come a point, at which you actually need to be holding the physical gold. We've already seen GDX and GDXJ separate from their underlying holdings back in late February, early March during the rout there, the prices of those funds actually fell further than their underlying holdings did. I could see the same thing happening with a paper gold fund where maybe some institutional investor, for example, wants to take delivery of a large amount and the price all of a sudden of the fund separates from spot gold. So there's too many risks out there like that that tell me we need to own not just gold, but physical gold until everything is back to normal, whatever normal may be. But that's frankly years away. There's too many things that can play out yet that could, cause gold to go a lot higher.
I really like that phrase that gold is this lifestyle protection hedge. So the question is, does price point matter? Should you buy gold at this price? Do you wait for a dip? How do you play this market in this scenario that you see?
So the answer to that question, in my opinion, is price matters if you already own gold and silver. Price is less important if you don't own any gold and silver. So I think it's imperative that someone get exposure, get some ounces under their belt of gold and silver. For someone like me who's been accumulating for a while, there's lots of people like that have been accumulating for a while, then you might get a little more picky about the price. I would be, if you look at the charts of the average price of gold and silver throughout the year, they tend to be very weak in late June, which is about where we are now, right? And into the first week of July. That tends to be the tendency. It's not a certainty, but that's the tendency. And so I personally wouldn't be surprised if we do see a little bit of a pullback in gold and silver prices for the rest of the month or next month. September is generally the best performing month of the year for both metals. So I would definitely want my exposure before then. So we'll see. But I would be very surprised if gold went below $1,600 an ounce. I would be very surprised if it went below $1,500 an ounce. So I think we're in an uptrend. There's going to be pullbacks. Those would be price points that I would look at if they were hit as a buying opportunity.
Okay, so we know you like gold. What about silver? I mean, does silver look good in an environment where industrial production looks weak? Which metal do you prefer? Gold or silver, or both?
I like them both, but for different reasons. The institutional world, the central bank world, the high net worth investor, those guys all flood into gold, especially during the initial stages of a crisis. Like we've seen, demand has been through the roof for all dealers, and they all flooded to gold. The retail investor tends to favor more silver because it's lower priced, but as you point out, silver has more of an industrial role, so it is affected by that. But let's be honest, the gold-silver ratio is at historic highs. It's near 100 again today. So, silver is dramatically undervalued relative to gold. Now, we've been saying that for a couple of years. That is true, but that is still the case. And history shows that in every single bull market for gold and silver lags in the beginning and then catches up and passes gold before that bull market is over on a percentage return basis. So that's one reason right there to hold silver. But I do believe that investors should hold both gold and silver.
So Jeff, let's put your feet to the fire a little bit. You're bullish on gold, silver. Where do you see prices by the end of the year?
Well, if you're going to put my feet to the fire, and I have to guess, I don't usually like to give, price guesses, and especially within a certain time frame. That's kind of a crapshoot, right? But can I just say higher? I do think gold is probably going to hit new all-time highs, meaning, above that $1,900 figure, either this fall or within your 1 year time frame. Silver is more of a wild card. I don't know. I tend to be the kind of investor that takes what the market gives me. I do think they're going higher. I'm heavily long in not just gold and silver, but the miners as well. So I have a lot of chips on the table for this particular industry. I'm not in the regular stock market at all, actually. And I fully acknowledge that that market may even go higher first. That wouldn't surprise me in the least. But I do think this is the place to be. They're still undervalued relative to history, especially relative to other assets. We've not seen any real world ramifications of all this Fed money printing, and even the recession isn't over. So in spite of some good numbers, so I feel very comfortable remaining long gold and silver. So you can have me back this time next year, and we'll see if I'm right.
I like that answer. It's hard to be wrong when you just say higher. That's fantastic. So here's another question that I've actually asked a bunch of different fund managers, trying to find a consensus here. What do you think is the right allocation for gold, especially, people being so bullish and seeing all this unprecedented money printing? Everybody sort of says the general rule is to hold 5 to 10% of your portfolio in gold. Does that make sense in this environment? Should you be more weighted to the 10% than the 5%? What are your thoughts?
I would stair step into gold, buy on dips and things like that. I may not buy all at once, but I would be heavily weighted toward gold. I would be overweight gold and silver at this particular point in history that we find ourselves. There are other times where you can be underweight gold and silver when the economy is doing well and we're not having these geopolitical conflicts and all. I mean, you can name it. There's a whole laundry list of things. So now is the time to be overweight. So I would definitely be overweight. 5% exposure to me is not enough. That won't be enough to offset, the kinds of things that are likely ahead for us. CPM Group did a long-term study. We did one as well. We showed that anything less than 10% is not effective as a hedge on a long-term basis for gold. CPM's research went back to 1968. It showed that 25% is the optimal holding or allocation to gold in a portfolio. So that's more along the lines of what I would shoot for.
Thank you very much, Jeff, for your time and this conversation talking about gold as a lifestyle protection hedge. It's been a fascinating conversation. We're definitely going to have you on a lot sooner than a year from now. So thank you very much again for your time.
It was great catching up with you again, Neil. So take care. We'll talk again anytime you want.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.